So the forward-looking things, the things that are driven by liquidity, which leads the business cycle by a significant period of time, had started to recover. Then you get into macro summer. Macro summer is when the economic machine starts firing up again. And that lends to another acceleration in markets and growth, whilst inflation tends to be falling or subdued. And that's a really lovely period because you can make money in pretty much everything. Commodities go up, gold goes up, small caps go up, crypto goes up, tech goes up, everything goes up. And that's where we are now.
Raoul Pal is a renowned macroeconomist, investment strategist, and co-founder of Real Vision. With a background in hedge fund management and global macro investing, Pal has become a prominent voice in the financial world, particularly in cryptocurrency and digital assets. In this interview, Pal discusses his bullish outlook on the markets, focusing on the impact of potential Federal Reserve rate cuts and the concept of global liquidity. He argues that we're entering an exciting period for investors, with significant opportunities on the horizon. Pal explains why he believes Fed rate cuts will be a positive catalyst for markets and delves into the sources and implications of increasing global liquidity. His insights provide a macro perspective on current economic conditions and their potential effects on various asset classes. So let's watch more clips from one of his recent interviews.
So what we get is, bizarrely, it breaks down pretty much by year, not perfect, but so 2022 was macro winter. We had inflation. We had recessionary conditions in all markets. It wasn't called a recession in the end, but regardless, everything went down and everything went to shit. Next year, spring. What happens in spring? You get shoots of recovery. What happened? Tech stocks, crypto, things in secular trends did really well. But the business cycle remained low. So the forward-looking things, the things that are driven by liquidity, which leads the business cycle by a significant period of time, had started to recover. Then you get into macro summer. Macro summer is when the economic machine starts firing up again. And that lends to another acceleration in markets and growth, whilst inflation tends to be falling or subdued. And that's a really lovely period because you can make money in pretty much everything. Commodities go up, gold goes up, small caps go up, crypto goes up, tech goes up, everything goes up. And that's where we are now. And so that summer period, the real footprint usually accelerates around the US election and after it. And that's when most markets have their best performance. So there is a seasonality around elections, which you tend to get a strong first half of the year or first part of the year. Then it tends to be a bit more sideways, which we had in tech and we had in crypto, and where the rest of the market started playing a bit of catch up. And then you get the acceleration that goes on for the end of summer straight into macro fall, which is 2025, when really the best gains come of all. So that's where we are. So back then we were just starting. Now what happened? Crypto went on a massive tear, then had that sideways consolidation. Tech had a massive tear, had a sideways consolidation. The rest of the market's now catching up. And the next phase is the money shot. It's both the end of summer. As I said, it doesn't actually fit necessarily with the end of the year. So we're still in summer. So basically, if you think late summer, the weather's pretty good. That's where we are. Somewhere in the middle of summer. So the weather's good. It's easy to make money. And this is the acceleration that happens around the US election years. And this has happened every time, is what I refer to as the banana zone, where everything goes bananas. And in crypto terms, the charts just look like bananas standing on end because they just go vertical. Because around the election period and the year afterwards, they all have to refinance, $10 trillion of debt. The Fed has not been able to the Treasury has not been able to refinance easily. So it's been issuing short end bills, which is basically a holding pattern for rates to come down. Wait for rates to come down and then you can refinance your rates. It's like you don't want to refinance your mortgage at highs. You want to refinance your mortgage at lows. So you keep your money in a money market fund, which is basically what the Fed did. And then they'll do that. So that period of massive liquidity tends to debase currency. We're seeing China coming out with the cowbell, more stimulus. The US has started the rate cut cycle. That's going to come down a lot. The EU have started. The UK have started. Everybody started. And so the big game is at play. Yeah, so rate cuts are actually a bit of a red herring. Liquidity really comes from central banks and governments putting money into the system. So we have something in the US called Fed net liquidity. So what is the three component parts of that state level liquidity? Well, that's driven by the Fed balance sheet, quantitative easing. They're still tightening, but they've reduced the amount of tightening. Then we have the reverse repo. And that is basically where banks mop up all of their funds. So if that's very big, money's tight. And when they start taking the money out, it goes into the banking system. The other side is the Treasury General Account, which is the checking account of the government. Now, if they've got a lot of savings and they're not spending it, which is where we are today, then conditions are tight. But once they start writing checks, what happens is that money floods into the system. And that is a kind of a net increase in money into the system. So if you make more of something and it's in abundance, its purchasing power or its value declines. So it's not that necessarily you and I get to borrow money more easily. It's not that. It's that there's more money around and it debases currency. It's like this magical thing that happens. Now, on the private sector side, the stuff like M2 growth and private sector credit growth is kind of a function of that, but they both work together because you can create dollars in a Eurodollar system. You can just create them out of thin air by being a bank. And so what happens is there is this huge increase in money that happens. But we as people don't generally get it. Sure, your mortgage rate may fall a bit, but really it's this debasement effect that happens that's more insidious that we don't see and don't really understand. Asset prices take off, but our earnings don't. So therefore, we get poorer in terms of the assets we can buy. And an asset is just future deferred consumption. If you buy gold today, your expectation is you can sell it in the future at a higher price to protect your purchasing power. But today, you can buy less gold than you could a month ago, and less gold than you could 5 years ago, and because your wages don't go up in the same as these scarce assets that move because of debasement, which is why property prices. I mean, when I bought my first flat in London, I was in finance, earning a decent salary, but I was young. I was like 24, and it cost me 3 times my salary. If I were to look at the same kind of person, 24-year-old, work at an investment bank early in their career, the same apartment will probably cost 10 or 12 times salary. That's debasement.
Okay. So it is insidious, and maybe are we talking about just more like asset price inflation then?
Well, that's the way that people see it, right? What they're actually doing is devaluing the purchasing power of money by 8% a year, which is the increasing global liquidity. But most people don't understand it. And so what happens is you have a savings account, you think you're doing all the right things, and suddenly you still can't buy a house. And you still don't buy much, you can't buy as many shares of Tesla as you wanted to, and you still can't buy as much gold as you wanted to. And you're like, why? I'm saving money, I'm working hard, but I can never get up the ladder. That's what debasement's about.
Yeah,
so what it's done is cause everybody to become a risk taker. And this is an important point. So really, of all the assets that we monitor at Exponential Age Asset Management, there are only 2 that beat the 8% debasement plus, let's say, 2 or 3% global inflation. So 11% is the hurdle. The S&P keeps track of it roughly. The NASDAQ does 17% a year return since 2011, and Bitcoin does 140. Gold doesn't meet it. Almost nothing else meets it. So you're really herded into 2 assets only that can actually beat this thing and make you money. So your future self gets wealthier.
So that was all about Raoul Pal's prediction on the global crypto market. He is very bullish and believes everything will pump sooner or later. And that's all for today. If you enjoyed this video, please give it a like, subscribe to our channel, and hit the notification bell so you don't